Hello and welcome to Simplicity in Stocks. In a volatile stock market, selectivity is more important than enthusiasm. Often investors chase growth, but dividends usually get sidelined. Yet dividends are important. Dividends signal that company earnings are translating into cash and the management is willing to share it. A company that can grow its earnings and still pay a healthy dividend is favored by investors. In this video, we will look at 3 such companies. Please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There are no views on any stock covered herein. Swaraj Engines. Swaraj Engines manufactures diesel engines primarily for tractors. Demand therefore moves broadly in line with rural incomes. The company has grown steadily over time and has consistently returned a large portion of earnings to shareholders as dividends. In 3Q FY26, total income from operations rose 37%. Margins came in at 13%. The longer-term trend for the company reflects operating strength. In FY25, revenue grew 18.5%, whereas operating margins were up at 14%. This indicates operating margin expansion driven by higher engine volumes, which increased to 168,820 units in FY25 from 138,761 units in FY24. The business does not require heavy capital spending. Growth is largely supported by incremental capacity and efficiency improvements. Strong cash flows and a debt-free balance sheet have historically funded expansion. Mahanagar Gas. Mahanagar Gas supplies compressed natural gas (CNG) to vehicles and piped natural gas (PNG) to homes and industries. It expands its network year after year across its licensed areas. The company combines predictable revenue growth with steady dividend payouts. In Q3 FY26, average sales volume stood at 4.6 MMSCMD, up 7.29% year-on-year. CNG volumes rose 6%. Domestic PNG volumes increased 9%. Industrial and commercial volumes grew 11.6%. For the 9 months of FY26, total volumes grew 9% year-over-year. An improvement in operating profit came from lower cost of gas sourced and the full quarter benefit of the September price hike last year. But growth has not been uniform across segments. Public transportation buses moving to electric has reduced CNG demand. The management, however, expects strong volume growth and has guided for the same. Nuvama Wealth. Nuvama Wealth operates across wealth management, asset services, and capital markets. The business has evolved into an integrated platform that receives tailwinds from the financialization of household savings. A growing part of revenue comes from recurring wealth and managed products, which supports both growth and dividend visibility. Revenue in 3Q FY26 grew 6.8% year-over-year. The company's cost-to-income ratio improved to 53.5% from 53.9% a year earlier, reflecting tighter cost control and operating leverage. The management's earnings expectation is 20 to 25%, driven by scaling up the number of relationship managers, along with offshore expansion and the market penetration of managed products. Even in an expensive market, growth stocks that also pay healthy dividends offer balance. These companies participate in India's economic growth, but they also return cash along the way. That reduces investors' dependence on stock price appreciation alone. The difficult part is separating growth backed by cash flows from growth built on leverage or narratives. Dividends often expose this difference. A company that can expand and still distribute cash is usually running a tight ship. In volatile markets, discipline matters more than excitement. Look at free cash flows, capital allocation, and the company's balance sheet. Do not mistake price momentum for business strength. Over time, steady earnings growth combined with consistent dividends is what quietly builds wealth. Happy investing.